Hi, everyone, and thank you for joining us today for our webinar, Homeownership is Within Reach, a guide for first-time buyers. My name is Kelly Blount, and I will be today's moderator. We have an informative agenda planned for you today to ensure you feel prepared as you embark on your journey to home ownership. With that, let's go ahead and get started. I'm going to turn things over to GECU's very own Mortgage Loan Officer, Jim Steeves, to introduce himself and share a little more about how GECU can assist first-time buyers.
Thank you, Kelly. Good morning. As Kelly mentioned, my name's Jim Steeves. I'm a mortgage loan officer with General Electric Credit Union. The credit union offers low down payment options for conventional mortgages, as well as FHA and VA mortgage options. Our one-on-one support from the time you first reach out until closing on your home helps you borrow with confidence, knowing you have someone in your corner and also someone that knows the local market. Our competitive rates and flexible loan solutions are designed to meet your financial needs. You can take advantage of our quick pre-qualification, low closing cost and rate reduction options, no required escrow, flexible payment options, including principal only and escrow only payments, and all of our loans have no prepayment penalties. We'll be here with you when you're ready to take the first step. Just give us a call and ask to speak with a mortgage loan officer, or visit our homepage at gecreditunion.org for more information. You'll feel right at home with us. Now it gives me great pleasure to introduce Jonathan Helms with Keller Williams Move to Loveland for today's home buying webinar. Jonathan?
Hey, how's it going, everybody? My name is Jonathan Helms, and I am a real estate agent with Keller Williams Pinnacle Group and the Move To team. Just so you know, I am not going to be as smooth of a talker as Jim there, so I'm going to stumble through some things. Very sorry, but I'll get you some great information today. But just be prepared, not as smooth a talker as Jim is over there. Okay, so let's get started. We are going to cover a good amount of ground today. So just know it's natural to have a lot of questions. We will definitely have a Q&A at the end. That way we can get some of those questions addressed, but let's dive into it. Okay, so a little bit about me. So I have been doing this for 10 years, which is hard to believe that 2014 is when I got my license, and that was 10 years ago. Time definitely flies. So the way it works, I work at the brokerage Keller Williams Pinnacle Group, but I am also part of a team based in Loveland, which is the Move To team and the Move to Loveland team. So I have been a part of that team for, I think, man, going on 7 years now. Prior to that, I was a solo agent at Coldwell Banker, but have definitely loved where I'm at and the team atmosphere, and you know, I've stayed put a long time. So really like the team aspect of what I do. So I represent both buyers and sellers. You will find that there are some agents out there who are just buyers agents who specialize in just working with buyers. There are some agents who specialize in just the listing side. Most agents do both. I fall into that category. So I represent both the buy side and the sell side, just depending on the transaction. I've sold over 170 homes in my time as a real estate agent. Again, hard to believe. And then I've been a top 20% producer in my brokerage the last 4 years. Also, I am not that great at PowerPoint, so just to set expectations in line here. I did my best, I promise. Okay, so how's the market? That is, we'll do kind of a high overview. That is a main question that we get, and I think understanding the market as a home buyer is very important. So, unfortunately, as a local real estate agent, we have to combat kind of national level news. So you hear a lot on the news, doesn't necessarily pertain to our market. So what I have on my screen now, these are the latest statistics from the realtors of Cincinnati. So if we take a look at this, it gives you a decent picture of what the market's like and what the market has, fortunately and unfortunately, been like for at least the last 4 years. So it's been a pretty hot market. So if we look here, you can see that the median home price, so year to date, so over this time last year, the market is up about 6.1% in home values. So you would have paid 6% more to buy a home this year than you would have at the same time last year. You can also see, so actually it looks like we did have a little bit more inventory this year, a whopping 2% more. So, but hey, you know what? If there's more inventory out there, if there's any good news, I will take that. The more inventory, the more there is to go around. So total sold volume, again, a little bit more in sales this year versus last year. These units over here, these are month over month. So median days on market, still very much a seller's market right now. So 6 days on market, that's it. And I can tell you a lot of those numbers are actually inflated. A lot of times, myself included, I like to have a listing hit on a Friday. So I will sit there and Friday, Saturday, Sunday, let people go through the house, and then I will mark it pending Monday. So a lot of these are fairly skewed, still a really hot market for sellers. Things are typically selling in a weekend, if not a day or two. So just know it's still a fairly hot seller's market out there. So going off of that graph and kind of expanding on it a little bit, it's still currently a seller's market, which is great if you have something to sell, not as great if you have to buy something in this market without selling something. Why is it a seller's market? So it's still a seller's market because it's really low inventory right now. People are just sitting on their homes. They're not selling as much as they did, let's say 6 years ago, and interest rates are going down. So when interest rates were up closer to 8%, it was still a hot market due to limited inventory. But right now, as rates go down, more buyers are getting off of the fence because they can afford more house. Unfortunately, there are still not enough homes to go around. So that creates bidding wars, and it creates an influx of buyers with not enough homes to buy. So unfortunately, when we say it's a seller's market, all that really means, all we're trying to indicate to you is to have the proper expectations that if you like a home, you're going to have to go in and likely offer, unfortunately, asking price, if not sometimes a little bit more to get that home. Not only that, you should go see that home as soon as you can and not assume it's going to be there tomorrow or Monday or whenever you can get to it. So definitely a speed to get to the listing in this type of market is very good when you are buying something. So if you see something out there that looks like a home run, go see it, don't wait. Okay, so we get a lot of questions about this. What do you think the market's going to do? Obviously, there's no crystal ball, but most of the people that I listen to, most of the financial forecasters, you know, we get a lot of people who are saying, I'm going to wait for home prices to go down. Unfortunately, the problem right now is that it's demand that is controlling the market. So there's not enough inventory, there's too many buyers. I don't foresee that changing in the future. Now, I don't think we are going to get appreciation, home prices increasing as fast as they have over the past 4 years. That does not seem sustainable. But just know, I don't think anybody's foreseeing a market crash. I don't think home prices are going to go down, but it does seem like there will be slowed appreciation. And what I mean by that is the past few years, it's been an 8 to 10% jump in home prices year over year. A more stable market, a more neutral market is closer to 3 to 4% increase in year over year in our Cincinnati market. So it's still a good time to buy now versus later because home prices are going to keep going up. But the good news on that is that they're not going to keep going up. Most likely, don't take this with a grain of salt, but you know, we don't foresee home prices going up 8% every single year for the foreseeable future. They are likely going to go up, but maybe 3 to 4% year over year versus 8 to 10%. But with interest rates coming down, I do think it's going to be a busy spring. I do fully expect home prices to continue to increase. The good news is there's still plenty of opportunity out there. There really is. It's just I like to tell you about market expectations and the way the market is. That way you can have proper expectations going into the home buying process. I think that's really important. That way you know what to expect, where to focus your attention, and how you can truly get the best deal with what's out there. Okay, we're going to get into the fun stuff. So how much money do I really need to buy a house? So I'm going to touch on some things with lending. I will let Jim speak to it to a greater degree, but just to set some expectations about the buying process. So most first-time home buyers use a product called an FHA loan, and that loan product comes with typically about 3.5% down. So for every $100,000 you finance, you need about $3,500. So if you were going to buy a $200,000 home, you would need roughly $7,000 as a down payment. In addition to that, loans do come with closing costs. What I mean by closing costs, there are some lender fees, there are some fees for taxes, there are some fees for closing documentation and recording your deed with the county. So there are just some various fees in addition to your down payment. So a lot of times when people think about home buying, they think, okay, I need a down payment. But it's not just the down payment. You do have some additional fees for that process that are going to come with buying a home. But don't worry, home buying doesn't have to be scary. There are tools out there for you as first-time home buyers. We're going to go through some of those. Just know there are ways that you can alleviate some of those costs for yourself. Don't feel like if you don't have 3.5%, you don't have $12,000 in the bank right now. There are ways you can go about the process that's going to help you as a first-time home buyer, and maybe you can go out there, buy your first home, and you don't need that $12,000 in the bank. So we're going to talk about some of the tools that you can use to offset some of those costs. Okay, so tools for purchasing your first home. So again, roughly for frame of reference, if you prepare yourself for about 3.5% down, and you prepare yourself for, let's say, $3,500 to $4,000 in closing costs, you're going to be setting yourself up for success. But here are some tools that can help you overcome that. If you're close, not quite there, or you're like, you know, I could do it, but I'd like to know my options and keep some money in the bank. Obviously, when you become a homeowner, you have to buy furniture, you've got other bills to pay, you've got homeowners insurance. So the more money you can keep in the bank, the better. Okay, so one thing you can do, know that as a buyer, you can ask a seller for some closing cost assistance. Now, one thing to keep in mind. So what I mean by that is, of that, let's say $4,000 in closing costs comes with your loan, you could go to a seller and say, hey, I agree to pay $200,000 for your house, but I would like $3,000 from you of that purchase price towards my closing costs. So they would be essentially crediting you $3,000 that you'd be able to not bring to the closing table. That would keep that money in your bank account. You wouldn't have to have that $3,000. It would go towards your closing costs, but the seller is going to pay it. One important thing to note, if you're going to do that, just make sure you're looking at homes that have maybe been around, didn't go under contract the first weekend, aren't going to go into multiple offers. So just know that's something that you can certainly ask for. You just have to kind of be out there looking at homes that aren't as high demand, maybe as some others. A home you still really like, a home you love, maybe they overpriced it and it sat for 2 weeks. You can swoop in there and say, hey, you know what, I'd love to buy your house, but I'm going to need some credits from you to help towards my closing costs. Another route you can go, if you have awesome family members on your side, you've got an aunt, an uncle, mom, dad, definitely get with GECU and Jim about this, because there are some rules in place, but you can get a gift of funds from a family member. So what a gift of funds means, it's not a loan from a family member, it's nothing like that. It is a gift. A family member is saying, hey, I'm going to give you X amount to go towards your down payment, things like that. So you can receive financial help from an outside party to help with your purchase. So that's something that you can talk to a lender about, and they can coach you through that. Some other loan types you can do. So an FHA loan is widely applicable to many different homes out there. Most homes are going to be able to go with an FHA loan, no problem. But let's say if you were looking at a more rural area, somewhere like Goshen, for those of you familiar with the Cincinnati area, Goshen is right outside of the Loveland area. It's considered more rural. It's less population dense. You could qualify for something called a USDA loan. A USDA loan is a specific product for rural areas where there is no down payment associated with the loan. It has a little bit higher closing costs, but you don't have to have that 3.5% down. and it only is going to apply to certain areas, but depending on where you're looking, it could be a big boon because you wouldn't have to have that 3.5% down. You would just have to have money towards closing costs. And in a lot of situations in the past, I've been able to get the no down payment loan with something like USDA and get some closing cost assistance from the seller. There are also, if you are a veteran, you could get a VA loan, which again is a no down payment loan for those who have been active military. So that's definitely something to ask a loan officer about as well. Again, it does have a little bit higher closing cost fees, but you don't have to worry about that down payment. So it's if you've been active military, it's a great product. Also, there are first-time home buyer products out there that could come with grants to help with closing costs and closing costs or down payment assistance. There are also loan types that have lower closing costs. So that's something you can investigate with a lender as well. So great thing to start the process of home buying, just so you know where you're at financially, what your affordability is to talk to a lender, see what your options are, see what loan products they offer, and see how they can help you with keeping some money in your pocket throughout the process. Okay, so how do I get started with the home buying process? So you've been saving up and you're ready to start looking. First thing to do, like we just discussed, would be get pre-approved. One thing I always tell my clients, so obviously it's easy to go out there, window shop on Zillow, Realtor, Homes.com, any third-party site, and they have a payment calculator on there. Don't trust that. A lot of times it's skewed towards a 20% down payment. So unless you're getting in there, you're plugging in taxes, you're plugging in all of the right financial information, the payment may not be correct. So what you want to do is make sure that you talk to a lender, see what your affordability actually is, where you're comfortable with a payment. What you don't want to do is go out there and start looking at $300,000 homes. You fall in love with the space, you fall in love with the finishes of a $300,000 home, then you go to get pre-approved, you're pre-approved for $225,000. That's going to be a very different house. Do not shoot yourself in the foot. Do not fall in love with a higher price point house and then have to backtrack, go and look at a $225,000 house and be disappointed. So the first thing you should do is talk to a lender. What's great is you could even walk into a lender's office, say, hey, I saw this house on Zillow I really like. This is the price point. This is the address. What would a payment be on this property? They can pull up the taxes. They can give you the nitty gritty. They could give you a really good idea of what your monthly payment would look like. And then you can use that and have a more informed decision. Okay, that's a little bit more than I'm looking to spend. I'm not quite comfortable with that monthly payment. Or, hey, that's great. That's less than I thought. Maybe I can qualify for a little bit more. Find an agent you like and trust. So there's a lot that goes into the real estate process. So my best advice for you as well is to go out there, find a real estate agent, interview people, see who you like, see who you feel like is pointing you in the right direction, who's responsive, who's going to answer your questions and not just put you off. Align with them, and they're going to guide you through the whole process. Really, the job as a real estate agent is not as much finding you the house that you want. It's more navigating you through the inspection, getting you in touch with a local lender who is going to do right by you and have great customer service and guide you through the process. It's about getting you through the appraisal. It's about getting you through the negotiations after the inspection. It's about attending the closing with you to answer any questions that you have. So there's just so much throughout the process. It's not just finding you a home. It's really more of a trusted advisor role. So go out there, talk to some agents, hop on the phone, call some agents, see who you like, move forward with working with them, and it's going to do you a world of good rather than just hopping on Zillow, clicking on a showing request, going out there and meeting 16 different agents who aren't going to give you the time of day. So find somebody you like, interview them, get referrals from friends, find somebody you trust, move forward from there. Okay, go look at houses. So that's really what you got to do, right? You can look at them online all you want, but each house, as much as it can make sense on paper, anything like that, every house you go into is going to have a certain feel to it. So there are going to be some houses you absolutely love the pictures online and you're sure you're going to love it. You go to it, smaller than you thought. The natural light's not very good. It just doesn't feel very homey. And you're going to find some that you were so on the pictures. You go through it, you love it. They were just terrible pictures. So there's no magic number. I've shown some people 5 homes. I've shown other people 75 homes. Me personally, I prefer when it's closer to the 5 to, you know, like 20 homes, but I will definitely show as many houses as it takes to find the right one for you. So it's a big commitment. It's the biggest purchase you're going to have in your life. Go out there, see stuff, and believe me, when you find the right one, you'll know. It really truly will just jump out at you. You won't be able to stop thinking about it. You'll go to sleep, you'll wake up, you'll still be thinking about it, and you'll know in your gut that if you missed out on that house, that you'd be really sad. And that's a great indicator that that's the one. Okay, so just a high level view of the process. After you find a home you love, you make an offer on it, you negotiate the terms, you get it accepted. After that, you will have a home inspection. So just know, after you get a house under contract, you're going to have a whole home inspector go in. He's going to get on the roof. He's going to check out the foundation. He's going to make sure there's no termites. He's going to run your heat and your AC. He's going to make sure the house is great. And if it's not, most of the time, you can ask for repairs. So just know you're not going to have to buy a clunker of a house. You're going to get an inspector, and he's going to tell you exactly what to expect with the house. After that, you move on to closing day, and there's a little bit more in there, but just for the sake of a high level overview, you move on to closing day. Just know most closings happen in about 30 days. So different loan types can take a little bit longer, but typically right now we're seeing sellers want things to move a little bit more quickly. So I would say the average closing date is about 30 days. So from the time you find a house you love, you get it under contract, you go through the whole process, everything's great, you get the keys usually within about 30 days. Okay, so that's all I have. I know I threw a lot at you, fully expecting some questions here, but I will turn it back over to Kelly now, and we'll get some of those questions answered for you.
Perfect. Thank you, Jonathan. As Jonathan mentioned, we'll go ahead and open it up for Q&A. Give me just a second. All right. So like I said, we'll open it up for Q&A. If you have any questions that you thought of during today's presentation, go ahead and submit that using your questions feature, and we will get to as many as we can or until we run out of questions. So let's go ahead and get started. Our first question that was pre-submitted with registration says, what is the typical time frame for the pre-approval to closing?
Oh, so that's a good question. So from my perspective, I would tell you as a real estate agent, a pre-approval is usually good between 60 and 90 days. So you might get pre-approved and inventory is a little bit slow. You could get, you know, it could take you 3 full months of looking until you get something under contract. And then once you get something under contract, it'll take about a month to close. So really and truly, it depends on how quickly you find a house you love. Could be 30 days. You could get pre-approved on a Monday, go out, find something on a Friday, and be in a house a month later.
This next question is asking, as I start to tour homes, what are some key things I should begin to look for?
Absolutely, that's a good question. So some things you need to look for as you're going through the house. Hopefully you're going through it with an experienced real estate agent. One thing a good real estate agent will do as you're going through the home is they've been through the inspection process. They've been doing it for years. They know the types of things that are going to come up on a home inspection. So as you're walking through a home, hopefully you're going to be coached through, hey, it looks like the water heater is 12 years old. Typical lifespan of a water heater is about 11 years. So just know it's probably towards the end of its life, still working fine, but just know sometime in the next 5 years that might go out. Hey, it looks like a lot of these windows are kind of foggy. That means they have ruptured thermal seals. They still operate totally fine, but they're always going to look a little fuzzy until you replace them. So hopefully, as you're going through a house, you're just getting a little bit mentally prepared of the things that are going to come up that are wrong with the house. So that way you can make an informed decision on whether you want to write an offer on that house, whether the things that are there are too much for you to take on. Like if there's a major foundation crack that looks like it might be an issue when you go into the basement. Hopefully you just keep an eye open for those things And really, again, hopefully you got a great agent with you. That way you can focus on the house and just make sure that the space works for you, that you like the flow of the home, that the bedroom space works for you. You can fit all your furniture in it, and that, it's got a great yard that you love. So I would say as you're going through the house as a buyer, focus more on the things you're looking for, whether it has a great yard, how's the curb appeal, how's the feel of the house, does the space work for you? And hopefully you're with somebody who's kind of pointing out some of the stuff that might come up, that just making sure there's no deal breakers there for you.
Our next question says, where can we learn about first-time home buyer grants? And is it a myth these are only applicable in low-income areas?
Yes, as far as I know, that this is more of a question for Jim, but talk to a lender. There are different grant types. There are lenders out there who offer different types of first-time home buyer products. So there are some products out there that have grants attached to them for first-time home buyers that may run out. So if it is truly something like grant money, usually I think they start in March. Correct me if I'm wrong, and I'll let Jim jump in on this answer. But so let's say there are a bunch of home buyers out there, they've all qualified for this. Once the money is up, it's up. So there are some first-time home buyer products where you are on a pretty tight timeline. But if you talk to that lender like GECU, they may have another product for first-time home buyers. That's their own product that offers some, either maybe like a low closing cost option, or maybe they cover part of your down payment. So there's no real one size fits all product out there. I do not think they are tied to low income communities. I do think that is a myth. And just know there are multiple product types out there. So even if you do run up against a timeline and you can no longer get a first time home buyer grant style loan, there may be other options out there for you. I don't know, Jim, do you want to chime in as well?
Yeah, I would. You're absolutely hitting it out of the park, Jonathan. With everything you're saying on this, there are just tons and tons of different types of grant programs. We're really excited about one of our options to try to do a conventional mortgage down to 3% on the down payment requirement. So we try to explore what we can, first of all, in-house with our options. And if we have something that fits, we find this oftentimes helps our members become more successful than trying to go with some of these other programs, like you said, that may have expirations or they may run out or things like that. So we are always trying to find what's our best fit on kind of a case-by-case basis. So it's always good. And I want to echo what you said as well with your PowerPoint, which I think was great, by the way. I love your PowerPoint. You shouldn't downplay yourself on that.
Thank you.
Yeah, absolutely. I get a lot of calls on this where folks, I think, have been doing the Zillow or whatever on their own, and they really want to put in that offer, or they maybe are trying to do so. Again, getting with an agent like yourself or someone that maybe through trusted family or friends, they recommend someone, definitely get yourself a good agent, especially in this economy, this market. And like you even said, our pre-qualifications are good for 90 days. It is very, very advised to get that pre-qualification letter. So you are ready in the moment when you find that place and it's checking all the boxes of stuff you're looking for, you are ready to make that offer immediately. And again, we can have that conversation while we're putting together the pre-qualification to see what are some of the best options for each applicant. So yeah, I don't know if that directly answers that particular question, but overall, yeah, get over to us, contact us, and we will dig in deep to see what options are available.
Our next question is asking what fees are associated with closing costs.
Now, I don't know if that's us again here, Jonathan. It will depend lender to lender what their fees are. I find, interestingly enough, sometimes we will get loan estimates from other lenders where someone says, yeah, I'm already working with X, Y, or Z lender, and they send it over to us. And, we're more familiar. We're also a not-for-profit. So, I'm always here just to try to help the members however we can. I find it interesting kind of helping to interpret a loan estimate for the person who's got the offer on the table there, and kind of helping to determine, like, are they buying down the rate, things like that. That sometimes I think loan officers are doing this with maybe all their good interest at heart for the person, but they may not be realizing some of the fees that are associated. On our side, we absolutely will go over some of these different generic closing cost fees and options to try to absorb some of them if that's something that is of a major concern for them. But yeah, there's always kind of like an appraisal fee. Members can shop for different title fees. So some of these things can become variable, but we go over that through our conversation once you have a purchase contract.
This next question was just submitted. It says, if my current rent is not too high, would it make more sense to wait in buying a house to save for a higher down payment, or try to buy earlier with a lower down payment to avoid increasing home prices?
That's a tough question. So I think the real answer is what's at the end of that question. Home prices are never going to go down. At least I do not think so. I don't foresee any type of 2008 crash, which really, long story short, was caused by a flood of inventory of foreclosures. So cheap homes all over the place, which drove prices down. So with limited inventory, prices are not going to go down. So really, it's just a question of what you're comfortable with. I will tell you, I bought so we own our second house right now, and we bought 4 years ago. And I thought we were buying, even as an agent, at the top of the market. I was like, oh, it's 2020. Things are insane right now. I'm going to buy prices at the top of the market, but that's okay. We're going to live here till our kids are in college, which is, 10, 12 years down the road. So that's okay. We'll absorb those costs. Well, now our home value has gone up $200,000. So one nice thing about being a homeowner is that you do build that equity, which is not something you're going to get as a renter. So home ownership, likely as a whole, is slightly more expensive. So just know when you buy a home, unfortunately, Murphy's Law happens. Which, what I mean by that is stuff's going to happen. Your water heater is going to go out. Your AC is going to go out in August, and you're going to have a $500 repair bill. So are there some extra costs with homeownership? Yeah, 100%. But if you can get to a place where you're comfortable and maybe your payment is slightly lower than your rent, or at your rent, or just above where you're very comfortable, you're going to start building your equity in your house faster, which just means that if you have a big life event, let's say you're a young couple and you move into a smaller first-time home, and then 7 years from now you've got a family and you need to upgrade. That's extra 2 years that you've been building equity in your house in a hot market. So you're going to pull a lot more money out of your house when you do have to sell, versus if you wait and you pay more for the house and then we get a slowed market. Let's say we get back to regular 3 to 4% increase in value year over year, 2 years down the road. So long story short, if you can, I think it's always a good idea to buy sooner if you're comfortable with it. That's the thing. Don't stress yourself. Don't put yourself in a position where you're house poor, where you've got this great house, but you have to invite your friends over all the time because you can't go out. And then your friends stop calling you because they want to go out. They don't want to hang out in your stupid basement all the time. So don't make yourself house poor. Make sure you're comfortable with it. But when you can, a house really is an investment where you can potentially pull more money out of it the longer you're in it. So if it makes sense financially, I always advise to buy sooner if you're sure you're going to buy. So I think that would be my answer. If you're sure you are going to buy in the near future and you can do it now comfortably, house prices are only going to go up and you'll continue to build equity the sooner you buy the home.
And just to chime in, I 100% agree with Jonathan. Like I said, if you find that place, that home, you're like, it's that checklist, your self checklist, like, oh my gosh, there's this place in Loveland and it's the area I want to be. It's the school system I like. It's near my work for commuting and all this. If it's checking all those boxes, and even though you're not feeling fully prepared to get it, you can't change the location of that home. So like once that home's gone and sold, now the next available home that checks as many boxes might be, I don't know, let's just pick a different place, right? It might be in Delhi, and you're like, well, holy cow, I don't want to buy a home in Delhi. It's on the opposite side of the town here completely. So if it's got your wish list of stuff, sometimes the sooner is better, and that's where that experienced agent is there to guide you. And on the lending side, we do everything we can to make it as affordable as possible.
Thank you. Our next question is asking, what is the recommended credit score going into pre-approval?
I can take that one. We're typically, for us, especially because of our program with this nice low down payment option plan that we've got, we're typically looking for credit scores around 680 or higher. We can work with lower scores, that's fine. I will say when they do dip down, they get into the 500s, I would recommend taking some time to rebuild or assess what is driving your credit. Not to create a long story on this, but I found it quite interesting. Years and years ago, I was helping out one of our members, and she had a loan with us and perfect on-time pay history, all this stuff, and she wanted to do a new loan. And in between getting her first loan and the new loan she was applying for, her credit score had actually dropped. And here there was one item that she didn't realize was being reported negatively against her. And we actually saw it and advised on how to get rid of this. It was a minor issue, and she needed about 6 months or so after that. And boom, she was back in a much better situation for qualifying for better rates, different programs that are just offered for folks with better credit scores. So it's good to keep like check on your credit every once in a while as well. Yes, we're looking for 680, but I'll just throw out there, there is annualcreditreport.com, a free service where you can check on your own reporting to make sure that you've got things reporting correctly. I'm not a big advocate of other paid services to monitor that, but I do like the annualcreditreport.com.
And then along the lines of credit score, this next question is asking, what is the minimum credit score requirement for FHA loan and conventional loans?
So again, for us, we don't specifically put a hard and fast rule on that 680 credit score. That's more for our conventional program. FHA, I know, does go lower, and it does depend on lender to lender what their program can get down to, but usually they're down like around 620, maybe 610 is about the lowest. And that's why I say if you think your score is getting into the 500s at all, you're going to want to maybe take some time to do a little bit of repair.
This next question is asking, should you wait to pay off debts such as your car before purchasing a home?
That's a great question. I do get that on occasion. One of the interesting calculations we have to run through is called a debt to income ratio. And we never recommend paying off loans just to get pre-qualified. What if you never find that house that you were trying to get, right? Pre-qualification is good for so many months, and now you've gone and you've thrown a whole bunch of money at paying off a car loan that maybe has a $15,000 balance, and you could, it's kind of back and forth. I could use that $15,000 for my down payment. Oh, I could do it. So before paying off anything, I would recommend going through the pre-qualification process and having us look at this and see, what could be problematic if there is an issue at all. There may not even be one in the first place. So it's better to look before you leap.
And then you mentioned the debt to income ratio. This next question is asking, what is that preferred ratio for a loan?
So that is also going to be lender specific. On our side, if we're going with our conventional program, we can get as high as 50% debt to income ratio and still have it meet our guidelines. And this is based on gross income. I'll throw in a quick caveat. The W-2 employee type of folks are very easy to qualify. It's pretty straightforward. If you are self-employed, that can be a little trickier. There you go. See, Jonathan, it's a little trickier. We typically are looking for a minimum of 2 full years of working in that same self-employment. So you can't be switching what you do every few months. And having, say, like your filed tax returns for the loan officer to kind of review. We do get folks that are confused sometimes, or at least maybe it's not clear cut, I should say that way. It's not clear cut if they're thinking about how much maybe their gross profits are versus what they really did net at the end of the year. So we're looking at more after everything's been paid off, and if there's any other issues that reduces that income, we're looking at what's left at the end of the day.
It looks like we're getting down to our last couple of questions. This next one says, if I don't find a home within the 90-day pre-qualification, how does this impact my credit score to get another pre-qualification to be prepared to buy a home when I find one?
Another one for me, Jonathan. For us, my typical response for that, even if you have great credit, for our program, we do a hard pull on your score. If in general, you know that you easily qualified for whatever purchase amount with your down payment, you've got all this stuff in mind, just unfortunate you didn't find a place within that 90-day limit, our 90-day limit, each lender has their own limits. I usually recommend not reapplying immediately, but keeping in touch with your agent if you've got that, and keeping in touch with your loan officer. Typically, we can turn around a pre-qualification almost same day. So if you find something over the weekend and then you reach back out to me on Monday, and we've had a pre-qualification in the past with you, I can get you kind of back up and running pretty quick to get an updated letter back to your agent so they can show that, hey, you're back and ready to go again. That way it prevents having your credit pulled each 90 days. We're not a big fan of that. We know it does have a negative impact on your score, although your score will heal itself over the coming months again. It's just not recommended.
This next question is asking, how long after a bankruptcy discharge should I wait to apply?
Depending on the type of mortgage, usually the minimum is 4 years after the bankruptcy has been discharged. In some cases, it may be 7 years. So we have to look at how you're applying, and then what type of mortgage we can try to get you paired up with. And then we'll know whether it's 4 or 7 that we're looking for. But that's based off of the discharge date, not when you first apply.
This next question is asking, what is PMI and do I need it?
PMI would be put on for many of these first-time home buyers if you're not putting down at least 20%. So again, like Jonathan mentioned, you might have that family member or parent that has got a nice gift funds for you that you can use for a beefy down payment. If it satisfies the 20%, then we can kind of leapfrog to no PMI, which is great. Again, we love our conventional mortgage program. The nice thing with that is that even if you're doing 5 or maybe 10% or something like that, yes, you're going to have that extra mortgage insurance added. But with conventional, it will eventually drop off. Some of these other mortgage types, it will remain until you do a refinance down the road. And even with the refinance, you have to have that 20% equity in the home. So if you get a home and you got into the, get into that place and you just did a 3 or 3.5% or 5% for the down payment, and rates got better in say a year, and you refinance to get the lower rate, you still may have that mortgage insurance just because there hasn't been enough time and enough payments applied to lower the loan amount. And conversely, the home will continue to appraise in value, but not at a rate fast enough within 1 year to probably remove the mortgage insurance. That's something that's going to come down the road. It will be good. And the amount of mortgage insurance that you're paying will be a custom amount based on your application. So if you have better credit scores, if you have a little bit extra for the down payment, maybe you can do 10% instead of 5%, something like that. That will have an impact on how much that monthly mortgage insurance costs.
And it looks like this might be our last question. It's asking, is there a way to work with or work around someone who has a higher debt to income ratio?
For us, a lot of times we don't want to just say you're not pre-qualified. We may have to just look at different products or different loan amounts or purchase price amounts to see where we can get you to fit in. I 100% agree with Jonathan on becoming house poor. I don't like to pre-qualify somebody at the absolute maximum limits. It just sets you up for frustration, maybe is the best word, where you're in the home, but you feel like you can't do anything else. So it might be something that it is a case-by-case basis. Sometimes we can make it work. Sometimes it's just a matter of you might need to wait an extra year, try to get that next bonus or something with income. That's a really good question. It's tough to get around that debt to income ratio because underwriting is going to hold that really true. I mean, there's not a lot of flexibility once we get to the maximum limits.
So we have a couple more questions that rolled in. So this next question says, if my partner has a bankruptcy on their record, are they able to be on the loan with me, or would they have to wait the 4 to 7 years?
Yeah, it would be whether it's borrower or borrower and co-borrower. We look at the application as a group effort in a sense, so that bankruptcy would have an impact. Yeah, you'd want to wait for that discharge to be beyond the minimum time needed.
And then this next question says, is it in bad taste to offer less than the asking price, especially if it has sat on the market for a while?
Not at all. So time on market is really the biggest indicator. And I will tell you, like right now, so even though I'm saying, hey, it's a seller's market, one of the really common mistakes a lot of other agents are making, obviously I would never make this mistake, but a lot of people, unfortunately, we're all human. We all kind of overvalue what's ours, right? So a lot of people overvalue their home and say, well, my neighbor got 350. I can obviously get 400,000. So a good agent will go in and stand their ground and just nicely say like, hey, here's what your neighbors have sold for. They were maybe a little bit more updated than your house. I think we should go in at 350. A lot of times, ultimately, we are there to advise. So my job is an advisor role. I am not the boss in any way, shape, or form. So then if an agent might go in and just say, you know what, you're right, your house is worth $400,000. Let's throw it on the market. So you get a lot of stuff right now where people know it's a seller's market. They want to test the upper bounds of their price point. They think their house is worth X amount. An agent will throw it up onto the market for that amount, and then it sits because their neighbors were priced more aggressively at a better price point. And then, you know, maybe they got to a certain price point by getting multiple offers because their price was really attractive. So a really good indicator that a house is overpriced right now is if it's been on the market for, I hate to say it, this sounds absolutely ridiculous, but this is the truth. If it's been out there at least like a week, chances are it's because of price. It's usually because price, maybe the yard backs up to a louder highway, maybe the yard backs up to a neighbor and people don't want to be doing their dishes and looking at a neighbor's house. So if it's been around the block for a minute, if it's been on the market for a minute, that's a good indicator that it's probably overpriced or people are not at least willing to pay the price that they are asking. You can certainly offer below list at that point. Now, you know, use discretion. If it's been on the market 1 week and it's listed at 300 and you go in and say, I'll give you 225, you're probably just going to rub the sellers the wrong way. But, you know, if you wanted to toss something out there and say, hey, you know what, I really like your house. It's been on the market a month now. How about 265 and see how they respond? You can definitely do that. So lean on your agent, but definitely not a faux pas to list to make an offer under the list price if it's been around for a minute.
All right, and that was our last question, so that will conclude our Q&A session for today. For anybody who has joined us, Jonathan and Jim's contact information is up on the screen. If you have any questions that you think of after the webinar or would like to reach out to talk with them personally, feel free to jot their numbers or their emails down. Those will be up for just another moment or so. With that, that is going to conclude today's webinar. Thank you all so much for joining us and have a great rest of your day.